Stop, whatever you're doing right now. Just stop for a second, because I need to show you something that is happening right now today in the Bitcoin market. Most people have absolutely no idea what's really going on. They look at the price around the high 60,000 range and assume everything is fine, that it's just normal consolidation. It's not. What's happening under the surface of that calm-looking chart is a high-pressure setup that could resolve violently in either direction within days, not weeks. In the last 24 hours alone, nearly $200 million in leveraged positions were liquidated, and most of them were longs traders betting on upside continuation, who got wiped out when volatility snapped against them. That's not random noise, that's positioning imbalance getting punished, which is exactly how this market tends to reset itself. Sentiment indicators are sitting in extreme fear territory, a zone that historically appears during panic phases, not comfort phases. Moments like this feel dangerous in real time, but they're also the same emotional environments where major reversals have formed in past cycles, not guaranteed, but repeatedly observed. The difference now is that the structure of the market has changed. Institutional ETF participation has introduced a new force that can add stability during inflow phases and sharp pressure during outflow phases. After spot ETF approvals kicked off a powerful rally cycle, price pushed to new highs and later corrected sharply from the peak. That correction, while large, is not unusual by Bitcoin standards, but the drivers behind it are more institutionally linked than in prior cycles. Recent ETF flow sessions have shown net outflows, including a notable one-day pullback from the largest products, partially offset by smaller inflows elsewhere but still net negative. Overall, think of the ETF ecosystem like a large pool of held supply. Even a modest drain can create a strong current in price when sentiment is already weak. Only a small percentage of total ETF holdings has actually exited so far, yet the price response has been outsized, which tells you how sensitive the market currently is to marginal flow changes. That sensitivity is one of the main risk variables traders are watching right now. Under the hood, on-chain and derivatives data show conflict rather than calm. Several large dormant wallets recently moved coins toward exchanges, which often signals intent to sell, while separate long-term accumulation addresses continue to absorb supply more quietly. Exchange balances overall remain near multi-year lows, normally bullish, but a portion of supply has shifted into ETF custody, where distribution can happen faster than from individual cold wallets. Volatility metrics show compression across multiple timeframes, with bands tightening after many days of range-bound trading between a well-defined floor and ceiling. The longer price coils inside that range, the more stop orders stack above and below it, increasing the odds of a cascade move once one side breaks. Institutional behavior also follows macro signals more than ideology. Large managers adjust exposure based on inflation trends, rate expectations, and portfolio risk models. When macro uncertainty rises, risk assets often see exposure trimmed quickly, and ETF structures allow that adjustment to happen with speed. Add in growing regulatory and tax reporting clarity pressures, and you get an environment where cautious positioning makes sense for big capital even while long-term conviction players continue accumulating in the background. At the same time, stablecoin balances on exchanges have expanded, representing sideline liquidity ready to deploy if momentum confirms direction, while futures markets still show participants willing to pay a premium for exposure that creates attention setup fear on one side, dry powder on the other. Technically, the chart structure shows repeated lower highs pressing into a stable support zone, a pattern often labeled bearish, yet when that structure appears alongside extreme fear and slightly negative funding, history shows an increased probability of upside squeezes as well. Price is hovering near its short-term average levels, signaling balance rather than resolution. In simple terms, the market is compressed, conflicted, and primed for expansion. From here, three realistic paths emerge: a breakdown flush, a squeeze reversal, or extended sideways chop, and the smarter move is not guessing which comes first, but preparing for how you would respond to each before the break actually happens. From here, the first path is the downside flush scenario. If the established support zone in the mid-60,000 range breaks with strong volume and price accepts below it, instead of snapping back, the chart opens space toward the lower support cluster near the low 60s. There isn't much structural demand between those zones, which means moves can accelerate once stops are triggered. That kind of drop is usually catalyst-driven: a macro surprise, a risk-off wave, or a visible acceleration in large-scale outflows. When it happens, it doesn't feel orderly. Liquidity thins, spreads widen, and leveraged positions unwind quickly. The damage in those moments is rarely caused by the move alone, it's caused by traders using too much leverage without predefined invalidation levels. The prepared participant already knows their risk, their size, and their exit rules before price ever touches the line. The second path is the squeeze scenario, and it's the one that feels least believable when sentiment is darkest. When funding leans negative and positioning crowds to the short side while support still holds, the market often searches upward for liquidity instead. A reclaim of the upper range with sustained volume can force short sellers to buy back positions, which pushes price higher, which forces more covering, which attracts momentum traders, a reflexive loop. These squeezes tend to be fast and emotionally uncomfortable. They feel like traps while they're working, which is why many hesitate and miss the core of the move. By the time confirmation feels emotionally safe, most of the expansion is already behind price. That's why professionals focus more on level reactions and volume acceptance than on emotional certainty. The third path is prolonged consolidation. Price continues rotating between the established floor and ceiling, breaking neither, with conviction. Both breakout traders and breakdown traders get repeatedly trapped. Volatility stays muted, then briefly spikes, then compresses again. This environment is mentally taxing because it denies resolution. Participants start inventing signals, over-interpreting small candles, and trading too frequently. Ironically, this is where discipline produces the biggest edge: reduced trade frequency, clearer filters, and patience for real confirmation instead of constant prediction. Not every profitable period is exciting. Many are simply controlled and selective. When you step back and connect everything, the picture is balanced tension. You have liquidation spikes, cautious large fund flows, and visible sell-side transfers on one side. On the other, you have long-term accumulation behavior, reduced exchange supply, meaningful stablecoin balances ready to deploy, and continued derivatives premiums that show professional interest hasn't vanished. Compression plus disagreement equals stored energy. Stored energy eventually converts into directional movement. The exact trigger is unknown, but the existence of pressure is visible. This is why planning beats forecasting. Instead of asking where will price go, the better question is what will I do if price goes there? Define the levels that change your bias. Define the conditions that confirm or invalidate your thesis. Decide position size based on risk, not excitement. Extreme fear environments historically lean toward better forward returns over time, but they feel worst right near the turning points, and that emotional contradiction is exactly why opportunity and discomfort usually appear together. Still, probability is never certainty, and survival always comes first, so the practical close is simple. Don't let headlines, social media emotion, or single short-term candles dictate major financial decisions. Use structure, levels, flow data, and risk controls. Accept that volatility is normal here, not exceptional. Whether the next expansion breaks down first, squeezes up first, or delays through more sideways grind, the advantage goes to those who already chose their rules. The market is indifferent, fast, and unforgiving, but a clear plan keeps you from being reactive inside the storm. Stay methodical, stay patient, and act only when your conditions, not your emotions, are met.